CEOs are telling us that the amount of resources that the company allocates to leveraging Chinese innovations, that is to say, innovations developed in this market, is not sufficient.
You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Steve Odland from the Conference Board and the host of this series. And in today's conversation, we're going to discuss the level of CEO confidence in China. Joining me today is Alfredo Montufar-Helu, the head of the China Center at the Conference Board. Direct from Beijing, welcome, Alfredo.
Thank you, Steve. It's great to join you again.
So the CEO Confidence Index is brand new. It's just been conducted. Tell us a little bit about the index. How do you do it? Who participates, and so forth?
Absolutely, Steve. So this index is something that we create based on a confidence survey to the CEOs of some of the largest multinationals that are operating in China. All of them are members of the China Center of the Conference Board. So based on questions about current, future business conditions and also business conditions on their own sectors, we build an index from 0 to 100. Any measure that is below 50 suggests that on average, their sentiment about business conditions is negative. Readings above 50 suggest that on average, CEOs are more optimistic about business conditions. So the latest measure of CEO confidence was conducted on April, so very recent. And what we saw in terms of the reading actually is cautious optimism from the part of CEOs, because the index just went up slightly from 54 6 months ago to 56, so barely above the 50 mark.
Yeah, so the 50 is sort of the demarcation line, and so going from 54 to 56, so they're slightly positive and cautiously optimistic about the state of business in China. What do you think is driving this slight move upward?
Well, Steve, there is no question that these are extraordinary times for multinationals in China. The combined effect of market, economic, regulatory, and geopolitical factors are leading to the emergence of what I call a new competitive reality. And this is putting business resilience to the test like never before. It's challenging all notions about the China opportunity, notions that were generated over the previous decades of high, rapid growth. And it's also forcing a rethinking of China's role as a key link in global supply chains. So MNCs are understandably taking a cautious approach towards their investments and operations in China. Now, the slight increase from 54 to 56, it must be said, it wasn't really driven by increased optimism about the outlook. It was driven by a decrease in pessimism about the outlook. Actually, a large part of the CEOs think that business conditions now and 6 months from now will remain the same. So it's more a stabilization of their sentiment, and it's important because the reason why we saw, for example, in 2020 and in 2021 and 2022, a decrease in optimism was because of the impact of COVID. Now, once China emerged from zero COVID in 2022, at the end of 2022, there was this feeling of optimism that China would actually grow back to where it was, and these expectations were not fulfilled. So it really hurt sentiment. But now what we are seeing is that optimism is once again rebalancing, let's say.
Yeah, and these MNCs are sort of multinational corporations. So they're headquartered, Alfredo, mostly in Western Europe and North America, right?
Absolutely. Some of them, however, are also headquartered in Hong Kong and some other Asian countries.
I got it. Okay, and so these are large multinational corporations headquartered outside of China for the most part, and then having business in China. And so these are it's difficult for these CEOs who are not Chinese natives, they're not state-owned companies, to navigate this environment because there are so many shifting sands in China.
Absolutely, Steve. One of the main challenges that China-based CEOs of these multinationals face, as I said, is that they are facing a new competitive reality. And again, you got to think about the previous 3 decades of growth in China, where profit was here, it grew very a double digit. And so the current market conditions are challenging those perceptions of what the China opportunity used to be. These are perceptions at the head office level, so in headquarters. So when you're a CEO here in China, you have to not only respond to the market changes, but you also have to convince your head office that continuing to invest in China has a benefit, that defending market share requires investments, and that they just need to continue betting on the market because this market continues giving opportunities. It's just that whilst before capturing the opportunity was easier, right now it requires a lot of recalibration of strategies.
Yeah, and the market in China is a little different than markets elsewhere. It's not completely a free market, governed by the invisible hand. It's essentially a state-directed economy, so it's a little different. And so if you're operating in China for China, which these CEOs are, you're really, you know, open to whatever happens to demand, and that demand is influenced by a lot of factors. Talk about that.
Absolutely, Steve. So one of the characteristics of the Chinese market is that when you compare it to Western markets, as you say, Western markets, they have the invisible hand. It's about the economic fundamentals. It's about the opportunities derived from market competition. Here in China, it's more about policies and regulations. So regulatory hospitality in China is extremely important, not only for foreign companies, but also for Chinese companies, even for state-owned companies. So for the MNCs, many of the opportunities that they have captured over the past decades is because the sectors where they operate actually received preferential policies from the government because the government wanted to develop them. The Chinese government always looks at the sectors and the areas where they face a development gap, and they always think about those sectors which are strategic from their perspective, which are a priority. And in those sectors, as we know, for example, right now in terms of technology, they come up with policies, come up with regulations, with financial support in order for them for these sectors to leapfrog. Right. So in many ways, this is what's driving the opportunity in China, and what will continue driving the opportunity for Chinese and foreign companies. On the positive side, and this is not related to the measure of CEO confidence. Last year, we had conducted some polls, which we conducted prior to our China CEO councils, which these are our two flagship events where we talked only with CEOs of these companies. And they told us that the receptiveness of authorities has improved, that the friendliness of authorities and the way they try to help foreign companies is improving, which is not surprising because China right now is facing a very challenging economic situation. And of course, foreign direct investment, continued business opportunities, employment, that's important for them. And so that it's really not surprising that they are trying to capture more of that capital investment for their economic growth.
So, what do the CEOs tell us about their sales, investment, and employment expectations?
Right. So the latest confidence survey, they tell us that sales, the outlook is actually improving. But again, a large proportion of them tell us that it remains the same. But it's better than 6 months ago. In terms of capital investments, the majority tell us that the level of capital investment will remain the same, which is positive because under the current conditions, there is a thinking that investment would decrease, but actually just the minority tell us that it will decrease. The only negative thing is employment. Actually, only 6% told us that they expect to increase headcount. It's a very tiny percentage. And a large part of them told us that they will continue reducing headcount to reduce costs.
Yeah, and that's a big deal in China. They have a lot of people, and they need the employment in order to keep things going. So, what do the CEOs tell us about their top risks? What are they worried about?
The top risk that they're worried about has to do with the economic weakness, because With a growth weakness, what comes is a change in consumption behavior. And what we're seeing right now in the market is that consumption is what, as we call it, downgrading. So people are buying similar products as before, but less expensive. In addition to this, demand is softening. So this is already hitting the profits of companies. Another risk is overcapacity. And overcapacity not only because it spills over into geopolitics, but also because it adds to deflationary pressures on the economy and, of course, pushes prices down. Another risk, very important, is the intensity of local competition. Because Chinese companies in China are fighting for survival. This is their only market. Now, foreign MNCs, this is one market in a global strategy. For these Chinese companies, they're fighting tooth and nail for every bit of market share they can take. And this is because, as I said before, consumers are downgrading. So what this means is that Chinese companies are competing by lowering prices, which means then that competition in China is being shifted to a lower price point, and this is hurting profits. Now, another big risk for MNCs is, of course, geopolitical tensions, because geopolitical tensions always, now that they have been increasing over the past months, for example, we saw that the European Commission has imposed temporary tariffs on NEVs, and China already retaliated by announcing an anti-subsidy investigation on pork imports from the European Union. So the more geopolitical tensions there are, it increases uncertainty. And when there is uncertainty in the market, CEOs find it very hard to plan ahead on how to respond to both negative and positive conditions. And also because it increases the risk for companies to be caught in the crossfire of tit-for-tat policy and regulatory measures.
Yeah, now, we have talked about the real estate market in our past podcasts, Alfredo, but clearly the real estate is a huge portion of the Chinese economy. Talk about the effect and the current status of the real estate market on the CEO's outlook.
Absolutely. Well, what's happening to the real estate market has really left a hole in aggregate demand in China. It was estimated that real estate by itself, and because of all the demand it generated for industrial activity, it contributed up to 30% of GDP growth. Households also had an estimated 70% of their wealth in household assets. And local governments used to get upwards of 30% of revenue from land sales to developers. So real estate is just that big contributor of growth. And of course, the situation is not like that anymore. So this is one of the main reasons why confidence continues being negative in China. And this is, of course, driving demand down. And the situation continues being the same. Real estate is still in a downturn. The Chinese government has been coming up with several measures to try to support a recovery or a rebalancing of the market. So the central government has come up with a refinancing program worth 300 billion renminbi, and it's focused on helping local governments buy housing stock to then change it into affordable housing. And so what this does is that they are leveraging up to diminish housing inventory. Now, 300 billion renminbi is not nearly enough to buy the trillions of renminbi that are in housing stock in China, but it is a signal that the government might be willing to increase more of their debt in order to reduce housing inventories. If that happens, the real estate sector might actually bottom out of its current downturn. And this could be a watershed moment for the economy. Yes.
We're talking about CEO confidence in China. We're going to take a short break and be right back.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge, from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspectives. I'm your host, Steve Odland from the Conference Board, and I'm joined today by Alfredo Montufar-Helu, the head of our China Center at the Conference Board. Okay, so Alfredo, before the break, we were talking about the real estate sector and the impact of that, and that the Chinese government actually views this as a big risk on their own, and they're investing back. But this is a pattern or a process that the Chinese government goes through. They prioritize certain industries, certain sectors, and they weigh in. So it's not a market-driven economy. It's a market and state-driven economy. It's a little bit of both, and that's it's a little hard to navigate. But they do try to level things out. How do the CEOs view that environment?
Well, it is, as I said, an environment where regulations and policies drive opportunities. And of course, the announcements and the policies that the government implements in the economy are, in a way, a signal of where business is going. So, under the current circumstances, what we are waiting right now is more of a signal from the government with respect to what they will do in order to alleviate the real estate situation and also to try to unlock the potential of development. Because what we have seen so far is that the government is stimulating the economy on the supply side. So a lot of investment is going into manufacturing in order to offset the drop in property investment. And this, as we know, is leading to overcapacity that is generating geopolitical tensions because of the probability of this overcapacity being exported and hollowing out strategic industries in Europe and the US. So that's a big problem. And the Chinese government understands that. But of course, this only on top of only exacerbating geopolitical tensions, it doesn't really solve the problem of ultimately what the government needs in order for the economy to grow sustainably is to increase confidence, is to increase demand. And so we're expecting some measures at the third plenum of the Chinese Communist Party, which is going to be held in July.
So as the CEOs look at the various sectors, which ones do they think are most attractive right now, and which ones do they think are least attractive?
That's a very interesting question because, of course, despite some sectors being challenged by the current conditions, CEOs actually remain positive about their ability to respond to the challenges, right? So they are actually recalibrating their strategies. We just had last week a CEO council session, Steve, and the takeaway of that from companies that are operating in consumer-facing sectors and companies that are operating more on the supply side is that despite the challenges, they will take measures to adapt, right? Of course, alignment with headquarters is very important. Maintaining the competitiveness of their products and services is important. Incorporating Chinese innovations is important, but they are trying to respond and they have confidence in their ability to continue succeeding. Now, having said that, and as we have been talking about today, policy and regulations are important. And the government has already determined that some strategic sectors are, for example, anything related to biotech, healthcare, NEVs, batteries. So all of those strategic sectors themselves present various opportunities for CEOs. So if you look at the healthcare sector and at the biotech sector, companies there are actually receiving a lot of opportunities in the market and also from regulations and policies.
Yeah, so consumer, healthcare, some manufacturing, particularly in energy, and so forth. How about heavy manufacturing or manufacturing for export? Are CEOs of MNCs focused on that, or is that largely driven by home-based companies?
Well, I mean, it's a combination. Some MNCs are also manufacturing to export to other markets, but the majority, of course, are Chinese SMEs that are exporting to other markets. We've seen exports increase over the past months from China to the world. There is a diversification going on from developed markets to the global south. But yeah, I mean, I think that mostly depends on how external demand is doing. What I could say the positive thing for exporters in China is that given how prices are going down in the market, when they export to other markets, they do it at competitive prices. For instance, we know that the European Union is going to already impose temporary tariffs on NEVs. Now, despite those tariffs, some Chinese brands actually they can absorb those tariffs and remain less expensive than their Western counterparts. So they're benefiting from that. So it's a combination of low prices, manufacturing capacity, and the ability to innovate, I would say.
Yeah, and the manufacturing moved to China for the most part because of the low cost of labor. It was a labor arbitrage play offset by the transportation costs to, get it to other markets. But that you've talked about this before, and you've written about the cost of labor in China that has risen, and that I guess that benefit is slowly disappearing, but not gone yet.
Absolutely. So the thing with with supply chains, Steve, is that they are dynamic, right? They are the way by which multinationals from whichever country, they're the way by which they are going to leverage the factor endowments of each economy. Now, those factor endowments change with time as economies develop. So for China, it used to be, or one of them used to be, the inexpensive labor. That has changed, right? So for companies that value inexpensive labor, they need to now shift to other markets. So they're looking at Southeast Asia, for example. So now China has risen to become more of an economy that offers research and development capacity and innovative industrial ecosystem, skilled talent, for example. Now, those factor endowments will also vary per sector. But what's interesting from our survey is that when MNCs think about de-risking, over 70% of them told us that in order to de-risk their China business, they are localizing more of their investments and operations. That in itself tells you that China already has an alternative for those very high value added supply chains, right? So China in itself already offers that alternative. Now, some of them are also telling us that they are not some of them, around a little bit more than 20% are telling us that they are also looking at other regions in the world to build alternative hubs of production. And over the next 2 years, 50, 58% of them told us that they are going to or are planning to shift supply chains to India, and a little bit less than 50% told us that they are doing the same and shifting supply chains to Southeast Asia. So it's a combination between localization and diversification. And of course, when I talk with the CEOs, what they want to do with all of this is just to increase the resilience of their global operations.
Yeah, yeah, and so that brings us to sort of the final topic area. And you cannot discuss business in China without thinking about the context of geopolitics. We at the conference board, of course, are totally nonpartisan and don't get into the politics, but the CEOs have to navigate this relationship between China and the rest of the world. Talk about what the CEOs told us about China's foreign policy relationships.
It is not such a positive result, Steve. There is a considerable degree of pessimism regarding the outlook of Sino-Western relations. 35% of the respondents expect that China-EU relations will worsen over the next 3 years, and 55% expect that China-US relations will worsen over the next 3 years. So it's quite concerning in my view, but those are the perceptions. In terms of why they think that, the friction points, actually for Sino-Western relations, an important one is China's relationship with Russia, for example. Also concerns about industrial overcapacity and about de-risking from China. So those are the three key friction points. Now, for the US in particular, actually, the South China Sea and cross-strait relations is a top friction point. So the combination of all of these in the CEO's perspective is negative for the outlook of Sino-Western relations.
Yeah, but CEOs have to navigate this. I mean, they may be domiciled in the U.S. or one of these Western European nations that have heightened tensions, but they have to stay neutral and non-political in order to successfully navigate this market, right? So it's interesting because they have to be aware of and cognizant of what's happening in these areas, but they've got to stay away from it in order to successfully compete, right?
Absolutely, Steve. And we have been helping them with that by building tools such as the Grace and Geopolitical Risk Monitor Analysis tool, also by hosting events, for instance, on geopolitical reputational risk management. And this in itself tells us that CEOs are considering how to do contingency planning, how to think about scenarios in order to remain objective, to look at how this is changing, and to take the appropriate response. They are preparing. They are obviously not just waiting to see what happens, but they are maintaining an objective view on everything. They are to say they're not taking sides, but it's a challenging time. It's definitely a challenging time, but it's a positive thing that to see in the events that we host at the China Center, to see how the CEOs are preparing, how they are aligning with their head offices on what to do, and to see that they're prepared to do what's necessary in order to face this very disruptive geopolitical environment.
Any final points that we have not talked about that the CEOs have told us?
Yes. So one of the very interesting results of the measure of CEO confidence survey is unrelated to this, to what I mentioned before, that in order to continue winning in China, the competitiveness of goods and services is imperative. Just maintaining that competitiveness is imperative. One of the things that we saw is that CEOs are telling us that the amount of resources that the company allocates to leveraging Chinese innovations, that is to say, innovations developed in this market, is not sufficient, right? And so that tells you also that the local competitors over the past decades have been innovated at a very rapid pace, and that in itself is what makes them extremely, extremely competitive, not only in China, but also in the international market. It's very interesting because last week when I was talking to some CEOs, being in China is not only about the demand of the market, is not only about the sophistication of its industrial ecosystem, it's also about preparing for the next 3 decades of growth. So if we think about the delta of growth over the next 3 decades, of course, the US, Europe, and China will continue being very important markets. But the delta of growth perhaps is going to be in the global south. The global south is where Chinese companies are very competitive right now. So if you want to prevent these competitors from eating your market share in global south nations, you have to be here in order to understand how they are competing, what are the new innovations, and how to remain competitive in the global economy. So that's very important. And in order to do that, the CEOs in China think that incorporating those innovations in China to the benefit of global operations is very important.
All right, Alfredo, thanks for being with us today and sharing these results on the CEO confidence in China.
Thank you, Steve. It was great to be with you.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.